The economy is expected to slow down, and the next move for the Fed is becoming a little bit more unclear. Will they pause their rate hike cycle, or will they keep on moving higher? Either way, how will the markets perform under these conditions? A conversation well worth your 10 minutes right here on UBS Trending. Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. I'm joined once again by my colleague from the Chief Investment Office, Leslie Falconio. Leslie, I want to get right into it with you because we're at this point now where we're expecting the Fed will raise rates on May 3rd by 25 basis points. But there still is a little bit unclear about what's coming next, just due to some of the economic data that we're seeing in the mixed picture between jobs, between GDP coming in a little bit lighter. Then you had consumer spending coming in at two-year high levels. It's such a weird picture. What do you see going on out there?
Well, I mean, I think you're absolutely right. The market is anticipating with about almost 100% probability that the Fed will raise 25 on May 3rd, right? But even if when we look at where we are in the cycle, which is really important, they're close to that pause, right? Whether it's May or June, they're very close to, in our view, sort of having the peaking level. Whether it's 5.25, 5.25, 5.5 is yet to be seen. But when we look at what the market's pricing in, to your point particularly, they really don't think of June. So they're only pricing in about a 15% probability for a June rate hike, which is exceptionally low. On top of the fact, they're also pricing in about 60 basis points of easing in the second half of the year. Now, our view is that that latter part, that easing, is probably not very likely. We would definitely take the higher for longer approach, and that higher for longer approach will obviously be a greater headwind to the consumer, to corporations, as they really start to and continuously feel the impact of higher borrowing costs. So we do think the 25 in May. June, I wouldn't necessarily rule it out, and I think that really when it comes to what the market will do, because there's such a low probability that's being priced in, as that probability starts to increase, you might see interest rates rise a little bit, and that's why we have the 10-year top at about a 370.
Right. I mean, there's a lot of economists out there who are sort of debating on whether or not they think that the Fed will, keep inflation high or sticky, as we call it in the biz. And because you look at what the Fed has done, they've already, when they look at personal consumption expenditures, which is one of their favorite measures of how the economy is doing, they had to raise their core inflation rate from 3.5% to 3.6%. So that's why I'm saying I think your assumption of what's going to happen at the end of the year, that they're not going to just start to cut rates 60 basis points before the year end, makes a lot of sense.
You're right. And this is obviously, inflation is more important than growth.
That's
so
right.
That's why we really think the higher for longer.
So while the Fed is perhaps entering a next phase, I mean, and look, we don't know if they're going to pause in June or they're going to go another 25 or whatever the rate may be. How do you see markets performing underneath the scenario that you expect?
Well, it's interesting because, I mean, to your point, if it's May or if it's June, we don't know. But more than likely, and we could say with probably a strong confidence level at this time, that the speech that Powell gave in front of Congress in the first week of March that was talking about 50 basis point increments and the terminal Fed fund rate going to 6%, is highly unlikely. So maybe another 25 in June is possible, but either way, as I said, you're really close to that point where they pause. Now, when we think about this, the curve has been inverted for a very long period of time. 2s have been inverted for over a year, right? So the short end yield is higher than the 10-year yield. Normally when they pause, right, the market thinks, what is the next move from the Fed, which will be an ease. So the market starts pricing in these easing, and therefore the yield curve steepens. Now, investors have this sort of misconception that, if you go from an inversion of the yield curve to a steepening of the yield curve, fixed income or, the performance in fixed income is going to be poor because they automatically think of a steepening and interest rates rising with, a good amount of momentum. And that's not the case. In fact, after a pause, the longer end or more the interest rate sensitive fixed income parts of the yield curve actually have a tendency to do well. And that's why one of the reasons why we're talking about locking in yield now is that just because, the yield curve is steepening when the Fed pauses, initially, right, it's done so where interest rates can come down. Over time, right, as they continue to ease, that's when you get the wait, growth and inflation scare again, and you have maybe interest rates rising, but it's not over like 6 to 12 months after the pause. So that's why we think it's a really good time to lock in now. And going from an inversion to a steepener does not necessarily mean that you're going to have a negative total return. Actually, the longer it actually outperforms.
Yeah, and as we talk about inversions with the yield curve inversions, which you and I have been talking about almost every time you've sat in that chair across from me, we always say that that is, by textbook definition, a recessionary indicator. Coincident indicator, right. So when you, and it's such a conundrum right now because equity markets are still moving higher. There's been some really decent earnings out there, especially from some tech companies, which is surprising. But there's still this fear of the banks that's going on out there. And then you have a couple of Fed officials, some are hawkish, some are dovish. There seems to be some dissension there. So there's a question about where to be putting money. And one of the interesting things that you've done in CIO is you still recommend quality bonds, but you've added high yield from an underperform to a neutral. Why is that?
You know, it's an interesting point because, you know, our view is that the economy does slow down in the second half, and actually we do think high yield spreads will widen. Mm-hmm. So particularly since how well they've done, you know, for the first 4 months of the year, not only has high yield done well, but the lower quality triple Cs are one of the top performing fixed income sectors, including all of them, high quality and low quality.
Interesting, isn't it?
It is. So with that said, people often ask, well, if that's the case, then why are you going from a least preferred to a neutral? Mm-hmm. And there's a few reasons for that. One of them is the fact that, as we know, high yield is a very high yielding sector right now. And although, you know, it may not be tomorrow, we do expect volatility to start to simmer down from what we've seen, particularly since March, as, you know, we get some more clarification, a little bit more data from the Fed. And really, having a least preferred and giving up that kind of yield can be very painful to your total return. Mm-hmm. That's the first thing. The second thing is that, as you mentioned, we have a least preferred in equity. We always talk about, you know, people need to look at correlations within their portfolio, right? And equity and high yield are very highly correlated. So when you have sort of a least preferred on both, you're really taking off a lot of risk, and that's another reason why we went to neutral. The second reason is that although we think spreads will widen in going into the second half of the year, we think interest rates come down. And again, we still have that carry. And the more that the interest rates come down, particularly in that short end, you're going to go back to this search for yield, and high yield might be one of them. Mm-hmm. So that's why we went to a neutral, to you know, not have as much in terms of taking off all this risk, to understand where we are with the carry, have the expectation of spreads widening, but that spread widening may not be enough of a headwind when you look at interest rates and the amount of income you can earn. So we're neutral. And when I say neutral, it's really important for investors to understand that high quality is still where we want to be at this stage. You don't want to really take on lower quality at this stage of the cycle, so we're not a most preferred, we're simply just neutral.
Right, so the recommendation on buying quality bonds like we've discussed is still very much on the table at this point in the story. And when you talk about rates coming down, is that in correlation with expectations for equity markets? Because I know right now in CIO, there's still a least preferred on U.S. equities.
Yeah, I think that is part of it. I mean, we all know the 60-40, how poorly that did in 2022. And listen, those correlations are coming back, and I do think it will come back. I think the 60-40 portfolio will be in a different framework in terms of its composition, but I do think the correlation of bonds and equity are really going to come back to what we know, and it'll mean revert back, particularly when you're starting with interest rate levels such as we did coming into 23, which was a 3.88 and 10-year yield. So that is part of it as well. And I also think interest rates are going to come down because I think there's a lag between, as we all know, what's happening with the Fed as it hits the real economy. Tightening lending standards are going to continue to tighten.
That's right.
You're going to have these pockets of vulnerability, so yields will come down by the end of the year.
All right, so here's the big question as we end. What's the takeaway here for investors? There is some heightened volatility. We are still wondering what the Fed's going to do next. We have a debt ceiling looming. We didn't go into details here, but we will at some point. Banks, still a lot of unknowns there, especially with the regionals. Where do we see interest rates going, and how does that play out over the short term?
Well, I mean, listen, I know that we've had a barbell on for quite some time, but I'm still a really big fan of the barbell. And the reason why I am, just actually some of the reasons why you just mentioned. When we think about not only the level of Fed funds rate at, 5%, combined with the volatility that we're seeing from the debt ceiling when we have that sort of these pockets of kinks in the bill curve moving higher, there's part of that short end that we really like. You have a lot of carry that you can earn there, and you should not ignore that. But you also have to pay attention to reinvestment risk and the fact that the Fed is close to a pause, and the fact that once that occurs, the market will push down that short end part of the yield curve, and you don't want to be in a situation when your cash is maturing and you just left 100 basis points on the table in terms of reinvestment. So we like locking in terms of that at longer end as well. We still like that higher quality because we do think we're at the close to, a cycle that's very mature. We're going to have slower growth in the second half. The magnitude of that slowness in terms of tightening lending standards is yet to be seen. It was already occurring pre this financial instability that we've seen. It'll probably get worse, not better.
Right.
So we do think that barbell is really the way to play it, and we do want to go into this higher quality because right now you're still earning a really good amount, a very, very good amount of carry, without taking on too much credit exposure, whether it's in IG corporates or agency MBS, which are AAA.
Leslie, thank you so much. I know there's a lot of out there that we are going to be waiting to see what happens, so we'll have to get you back. Good to see you, as always. Thank you. And for more information, please visit our website at ubs.com/views. Plus, check out our newly launched UBS Studios, UBS Trending Instagram channel. Some great content up there for you that you're not going to find here on the shows. And as always, if you have any questions, talk to your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, and remember to keep your eyes on what's trending. See you soon.